In 2026, the four biggest US tech companies are projected to spend around $650 billion on AI. On paper, that sounds incredibly bullish for semiconductors, so it makes sense that chip stocks have been running. But there is one detail that made the market react very differently. Amazon by itself said it could spend as much as $200 billion on infrastructure in 2026, and the stock got sold the same day. Because the market is not only looking at how much they spend, it is looking at efficiency, what happens to cash flow, and what happens to profitability. So is this $650 billion the start of a new chip supercycle, or is it the kind of build-out that goes too fast, creates overcapacity, and eventually compresses pricing and margins? In this video, I am going to follow three simple questions. First, where is the AI money actually flowing, and why do chips benefit first? Second, why can cloud revenue grow while the stock still drops, and what is the market really worried about? Third, why is AI shifting from answering questions to doing real work, and where will the profits ultimately land? And at the end, I will give you a 3-line checklist you can reuse for any AI spending headline. Is the demand real? Can they defend margins and capital efficiency? And has AI produced real profit yet? First, we need to understand what this spending actually is. This is not AI for the sake of AI. This is a race for compute capacity. If you want AI to generate profit, 3 things have to happen. 1, training so the model becomes powerful enough. 2, inference at scale, running it every day, every hour at massive volume. 3, productization, getting it into real products where real revenue happens. And that is why chips win first, because the first 2 steps consume infrastructure immediately. GPS, memory, high-speed networking, and data centers. If deployment starts, orders show up right now. But for big tech, the story is different. They have to spend upfront and then prove the profit later. So the market is really looking at 2 different businesses. For chip companies, rising orders translate into revenue quickly. For cloud giants like Amazon, Microsoft, and Google, they have to build first. Data centers, GPUs, networking, power, then they wait for customer usage to catch up. Which brings us to the 2 questions Wall Street obsesses over. 1, will the infrastructure be utilized enough? If you build too much and use too little, your returns collapse. 2, can they hold pricing and margins? If competition forces pricing down, profitability gets squeezed. That is exactly why, when Amazon said in 2026 it could spend about $200 billion on infrastructure, the market reacted instantly. Investors saw 2 things at the same time. Yes, growth. AWS can still grow, AI demand can rise, customers can sign bigger commitments, but also cash. $200 billion is cash that has to go out the door now. And when spending ramps that hard, free cash flow shrinks in the near term. The market does not hate AI. The market just wants clearer proof of 2 things: when utilization reaches high enough levels and when profit catches up. The most practical question is simple. Over the next 12 to 18 months, where does the efficiency show up? Amazon is only one piece of the bigger picture. The bigger question is whether the $650 billion creates a handful of true winners or turns into an infrastructure arms race where everyone builds, then competes on price, and spreads the profit thin. And here is the key point. AI can make everything more efficient, but that does not automatically make a stock go up. Markets do not reward a beautiful future. Markets reward something more specific. Who keeps the profits? For today's valuations to make sense, you need 3 things at the same time. AI has to create meaningful new revenue. AI has to create strong incremental profit. And it cannot be just one company capturing everything. Multiple players need to monetize. The problem is AI competition moves fast. Customers can switch stacks quickly. So revenue can be hard to lock in, while the investment is immediate and irreversible. Spending big does not guarantee winning. The money is real. Only the returns decide the outcome. So, what is the clean dividing line between a supercycle and an overbuild? Very simple. Does the capacity get fully used? If it does not, prices eventually come under pressure and margins come under pressure right along with them. A lot of people think 2026 could be the fastest ramp year for AI spending. Not because companies stop spending, but because 60 to 70% annual growth cannot continue forever. And there is a practical reason. Even if you have money, you cannot instantly buy unlimited supply. GPUs are not infinite. Power is not infinite. Data centers and networking are not infinite. When the entire industry tries to reserve compute at the same time, the first winners are the infrastructure sellers. AI chips, memory, high-speed networking, and data center buildouts. Because orders hit immediately. Now the market is split into 2 camps. The Supercycle camp says AI demand will keep growing for years. Infrastructure stays tight and chips keep running. The overbuild camp says capacity will grow faster than usage, overcapacity shows up, pricing gets squeezed, and margins get crushed. So which camp is right? You do not have to guess. You watch 3 signals. And the third one is the deciding factor. Now, the real separation where profits will flow. AI is shifting from answering questions to doing real work. Not just telling you what to do, but actually executing. Breaking tasks down, using tools, verifying results, delivering outputs. That matters because it answers the only question that truly matters. Is AI generating real economic value, or is it mostly a demonstration? The simplest test is whether AI completes the full loop: information, action, measurable outcome. A clean example is online shopping. If AI just recommends products, that is still advice. But if AI tracks price, picks the correct version, and automatically purchases when conditions are met, that is when real money shows up. And here's what gets interesting. Industries that rely on advice and then closing the deal, like travel, insurance, and retail finance, could see margin pressure if the gateway to the customer changes owners. So the real question is not how powerful AI is. The real question is who controls the customer touchpoint, because that is who keeps the profit. Let me close with the 3-question checklist. Use this on any AI spending headline. First, is demand real? Look for evidence, backlog, bookings, signed contracts, pre-orders tied to AI, not just slide decks. Second, can they defend margins? If spending rises but margins fall hard or capital efficiency deteriorates, the market will worry. Third, has AI produced real money yet? Do not ask, do they have AI? Ask, has AI driven measurable revenue, transactions, or cost savings? If all three are positive, that $650 billion can translate into real profit. If one or two are negative, the market leans toward the overbuild risk. This spending wave pushes chip stocks first, but big tech only gets rewarded when they prove utilization and returns on capital. Thanks for watching. Now a quick comment question. Which signal is most reliable for telling supercycle versus overbuild? A. Backlog or bookings surge. B. Infrastructure running at full utilization. C. Pricing power and margins holding up. Comment A, B, or C and add one sentence why. Next video, I will do a specific case study based on the top vote. If this helped you understand the AI spending race, hit like, subscribe, and share it with one friend who is watching chips, big tech, and AI. Thank you, and I will see you in the next one.